Hey guys, I think I should be live. Just testing. Shout at me if the audio or something's not working. But I'm going to do more of these quick, rough and ready videos, not big, polished models, because it's important to get the information to you guys as quickly as possible as it unfolds. So this is an unscheduled broadcast talking about JP, Jerome Powell, chairman of the Fed. This drives a lot of central banks around the world, and it's very important for Bitcoin and markets. It's an unscheduled broadcast. It's rough and ready. Let me know if you like this rough and ready format, but it's really, really fascinating to see what the Fed just said, what the White House is saying, where we are going, how to read between the lines, and what to expect for the market going forward. I'll try to do all that in less than 10 minutes. So first of all, no, this is financial advice. You know that. There was a news release that came out today. Is the White House is bracing for grim news on the economy. What the hell does that mean? Don't worry, I'll get to JP in a minute. But basically, senior administrative officials are hitting the airwaves, the blog posts, arm twisting, talking to reporters in private, trying to convince them to say, oh, everything is fine, house is on fire, nothing to see here, imploring anybody who will listen that the economy is healthy. But they know we are in a recession. So now they're trying to move the goalposts like I covered the other day, change the narrative, redefine exactly what a recession is. So let's talk about this. This is the new disinformation campaign. And again, I'm not a political animal at all, by no stretch. I don't care about parties or whatever. But Biden is clearly trying to get ahead of the negative economic news, like he was trying to get ahead of the negative inflation news. And they are trying to help frame the expectation around the GDP report, which is July 28th, which is tomorrow. I think it's 8:30 Eastern, 5:30 Pacific, whatever that time is in Europe. I'm not sure. Now, Chamath Chiming, big fan of his, he comes out and tweets about the recession disinformation campaign is pointless. It assumes people are either dumb or never believe the definition in the first place. It won't change what is actually happening to the economy or people, and will be dumb, he shouldn't have used the word dumb twice, but dumb to the point of debate if when GOP also tries to play the hide the cheese game. So what is this about? Again, this is based on the conversation with the White House economic advisor, Brian Christopher Deese, saying 2 quarters of negative GDP growth is not the definition of a recession. Boom, everybody's upset. Even Chamath is upset. Now let's talk about some of the mixed signals from the mainstream media. Don't worry, I'm getting to JP in a minute. But the US economy seen narrowly averting back-to-back contractions. Second quarter GDP forecast to rise 0.4% after a 1.6% drop. That is for Q1, by the way, 2022. And underlying demand metrics seen weakening on inflation bite. What is that about? So Bloomberg, which I respect and I read all the time, they think a recession is averted. Economists, GDP product grew here about EST 0.4 to 0.5% in the April to June period, which is Q2, not QT. It's quantitative tightening. Talk about that in a minute too, which on the surface would be an improvement after the big 1.6 drop in Q1. That's the little black line. It's very hard to see in this eye chart. And we'll see exactly what's happening. But let's look at this. Can we trust the mainstream media? I don't think so. I think people now have more faith in Twitter, even though it's a toxic den. But we'll see. Now, keywords. We're switching gears now for a second to JP and what he said at the FOMC. And this is really, really important. And you know, for over 2.5, 3 months now, I've been talking about the Fed being boxed in, multiple videos, Fed pivoting, Fed being forced to pivot, showcasing my model and why they are there. Listen to these words very carefully. I just literally wrote them down as he spoke live on TV, and I came here online. So first of all, there's a new word for inflation. It's called price stability. See, they're changing everything. They're even changing the narrative, changing words, changing definitions. Second, while another unusually large hike could happen at our next meeting, that is a decision that will depend on the data we get between now and then. That is code for the GDP numbers tomorrow. Okay. Third point, it may be appropriate to slow the rate of increases. Okay. This guy telegraphs really clearly. That was the last time I will bet my bottom dollar the last time we will see a 75 basis point hike for the next 20 years or ever, actually. And second, he keeps talking about the 2% goal of inflation. What a joke. But they really need to, as they're redefining what recession is, they need to redefine exactly how they calculate inflation. Then they can box into that 2% inflation growth. But 2% will never happen. It has never historically happened. I calculated last night the historic real inflation since 1980 to today, and I'll do a video on that if you guys want. And it is ballpark about 9.5% on average per year over the last 42 years. Next is we need to be nimble and strive to avoid adding uncertainty. That's good. Markets do not like uncertainty. He knows the markets need to go up. And we don't have to have a recession, but the path has narrowed. Okay. Now he's talking about recession. Path has narrowed. Again, some people describe it as flying or landing a plane on a tiny strip on an aircraft carrier in very, very stormy seas with one engine. That's the soft landing, which probably can't happen. Then he says, I do not think the US is in a recession. He's been told to say that probably by the White House because they're changing the definition. And finally, we don't know how much demand is slowing. That's kind of weird. We don't know how much demand is slowing. Basically, the economy has been like a bug on the windscreen of a car being hit by the car going 100 miles an hour. It's just everything is screeched to a halt. Covered that many times. And there's no guidance for September, which is good. So we're in limbo now for 2 months. But literally, I do think they will slow the pace of hikes. That's very clear from this. The increase will get very, very restrictive going forward. Now, what happened to the markets? This is crazy. The big gainers after 75 basis points. Look at this. Aave up 14%, Shopify 11%, MicroStrategy. By the way, these are kind of my favorite names, but I stat ranked them, sorted them by the change percentage. There's a lot of other stuff there, but these are the top gainers. And it's nice to see our top names being in the top gainers. Ethereum up 144 points, massive, back up to that $1,600 mark. Bitcoin, as we speak, is 22,830. Shot right up. It's even higher since I took the screenshot. Square, nearly 9%. Google, 8% after earnings yesterday. Solana, 7.6%, back up to almost $40. Nvidia, 7.28%. Tesla, up $47. Massive move. But don't worry. It's what typically happens after the market gets a relief. It's like a relief that the Fed didn't raise 100 basis points. Things shoot up. Tonight, they will digest the data. And then the thoughts will go towards the recession and the GDP number tomorrow. And then the markets will probably fall again. That's how it works. That's how you play the chop. Beautiful swing trading environment. Now, the retail economy, just a reminder, switching gears. US savings rate is at 4.4%, the lowest since 2008. 2 trillion was lost in the crypto market, and I don't know, 17, 18 trillion in stock markets, or 30 trillion, I don't know, some huge amounts. Credit card debt is up 20%, and it will hit a record 1 trillion soon. So as the rates go up, not only is it going to hit the government that is at 130% debt to GDP, but it's also going to hit retail individuals in their pockets hard, because you think the credit card companies aren't going to use this as an excuse to jack rates even higher. Mortgage rates more than doubled, absolutely bringing the housing market to its knees. Average rent in the US is at an all-time high, unless, of course, you own properties in rent control areas. And recession is clearly worsening. Proof that the recession is worsening, this goes fly in the face of that Bloomberg number. This is the Atlanta Fed, and they see recession clear as day. And here it's gone up a little bit, but it's still under -1%. And they tweak it every now and again, but that's what they see. And they have the best grip on economic indicators. So this is coming out tomorrow. We'll see where it is. It's about -1.1, -1.2%. We'll see. Many people a few weeks ago were thinking to be another -1.6%, just like Q1. Now, let's look at some background numbers. This is kind of crazy. When you look at the 10-year, it is down 20% since the last meeting. And that's 70 basis points. And you can see this pattern here is pretty clear. It likes to hover around that 2.76%. That is the long-term inflation expectation of the markets. Okay, now what's really interesting here is when we look at, again, tying in real estate, whenever homes, this is a 50-year analysis from Julian Bryden on Twitter, but it is a beautiful chart, yet another one. And if anybody wants me to do a deep dive into what's happening in the real estate market globally, let me know. But this shows you what I call the for sale versus the sold divergence for real estate. Now, if you go way back in time, I can't even read the numbers, but typically the recession, I think that was in the early 70s, the first block, you have the houses for sale, the yellow arrow going up, the orange line going up, versus the new home sold going down. So what you see is a big divergence. Things go on the market, but they do not sell. Again, happened in the late 70s. Again, it happened in the mid 80s, I think. Can't really see the numbers. Again, it happened in the global financial crisis, 2008, 2009. It was an elongated period. And it's happening again right now. And this is a scary time. And this always, 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 always precedes a recession. No ifs, ands, or buts. Another indicator, and I've covered many already. The other one that proves it as well, at least it's a point of evidence. Let's not say it's proof, because who knows what can happen, but heavy, heavy, heavy yield curve inversion. And it keeps going down and down. In fact, the 2-year spiked downwards to the tune of about 20% on notice of this Fed aggressive interest rate hike. So we'll see. And even Powell conceded they won't, these interest rate hikes do not reduce food or gas prices. And many key drivers of inflation are outside the Fed control. So why are they doing this? I think they're just trying to jawbone before they start pivoting again. And per this chart, I put a blue line at the bottom with a yellow box. Anything under that line is an inversion. We had a little bit of an inversion at the very beginning of April, I think. And right now, it just keeps going down and down. And that historically has always been a perfect indicator of a recession. So let's go quickly to our conclusion, where we are. So this is the math that I've been talking about for a long time. And here you can see the tone is key. I covered the tone. His language is definitely softening. Okay. We are now at that. I added the red arrow. We are now at the 2.5% to 2.75% level, because we added 75 basis points on top of what we already had. We can maximum go up no more than 100 basis points more. That will take us to a max of 3.5%. But I'm thinking they can only probably go maybe 2 times 25 basis points more, which is taking up to 3.25% interest rate. But at that point, they are smashing GDP growth. And that's just simply it. It cannot go higher. So the talk of continued 50 basis points, continued 75 basis points every meeting until January 2023 is physically impossible. And I've never been more confident in that until right now. And he is already signaling a dovish pivot. If inflation data changes between now and the September meeting, they just need to see it coming down. So are we beyond peak inflation? Yes, we think so. The only thing that is an open question is the owner's equivalent rent, the only thing out there. Finally, remember, everybody, we're not out of the woods. Yes, markets are going bonkers right now, but remember, recession is here, recession ahead, whichever way you want to see it. We will see. We'll find out tomorrow, 8:30 a.m. Eastern, if GDP is negative. Or maybe they're trying to cook the books. But going back to the very beginning, you can see that the White House is spreading disinformation and preparing and trying to strong arm the media. So let's hope the data is correct. We do believe we are in a recession, but remember, the markets rebound before the recession is even over, and the government and QE to infinity, monetary policy, etc., will bring the economy out of a recession as quick as they did back during the C-19 crisis. So with that, everybody, quick one today. Hope you enjoy the content. I got to put my thumb in the right place, and I'll see you all a little bit later. I'm going to try bring our scheduled viewing out if I can. So thanks, everybody. Hang tight. See you all soon.